Let's take a look now at a problem that we are going to work on, 10-1. Just so you know that the quiz is going to have a problem identical to this. Numbers will be different. A little bit of the scenario will be different, but it is going to be the same concept. The accounting for trusts is dependent upon donor stipulations. To promote computer education, a leading computer manufacturer donates $4 million to the Kerrville Independent School District. The donor stipulates that the district is to establish an endowment from which income only is expendable. Income is defined to include interest, dividends, and investment gains. All income is to be recorded initially in a non-expendable permanent fund. Each year, the district is to transfer to an expendable endowment fund, a special revenue fund, all income of the year that exceeds the rate of inflation as measured by the Consumer Price Index times the beginning fund balance. The expendable funds are to be used exclusively to acquire computer-related materials and to provide computer training for teachers. So basically what they're telling us is someone's donated $4 million for the school district. The $4 million needs to remain intact, but the earnings that are above and beyond the inflation rate is allowed to be transferred into a special revenues fund, and from that be able to be utilized for a specific purpose. So then it provides us with various transactions, and the first thing we are required to do is prepare journal entries, including closing entries in the non-expendable permanent fund to record the year's transactions. So the focus here is in the permanent fund, the transactions along with the closing entries. So the very first entry that we'll want to do is report that $4 million that was donated or that was given as a gift. So we will notice here the first entry will be cash for $4 million and a contribution into the permanent fund to record the initial contribution to a non-expendable permanent fund. Now remember, permanent funds are utilized to report non-expendable contributions, which is exactly what we're dealing with right here in this situation. And then it says, in the year the contribution was received, the district purchased bonds having a face value of $3 million for $2,970,000. And then they also purchased common stock for $1 million. So again, in permanent funds, we're going to utilize the modified accrual basis. So even though we know that there's a face value of $3 million, they purchased them for $2,970,000. Modified accrual, we don't deal with amortization, we don't deal with discounts and premiums. All we're dealing with are current resources. So we are going to show investment in bonds, $2,970,000, credit of cash, $2,970,000, recording purchase in bonds. Likewise, as far as our investment in stock, we're going to show an investment of $1 million, credit our cash for $1 million, and to record the purchase of common stock. So those are, again, treated on a modified accrual basis. We're familiar with when we're dealing with the full accrual basis, we will deal with the amortization of a discount or a premium. We're not doing that in this case because we're not dealing with full accrual basis. Next, we received $180,000 in interest in and recognized an increase of $3,000 in the fair value of the bonds. So because it's a marketable security, we record those bonds at fair market value. We're showing our cash of $180,000. We'll show an increase in investment in bonds of $3,000. We'll then show interest income of $180,000 and investment gains that are unrealized. We're not going to realize them until we have actually sold that investment. But for the time being, we are going to record them on our books at fair value, the marketable fair value. This records the bond interest and the appreciation. Next, we sold $500,000 of the common stock at a gain of $50,000, and we used the proceeds to purchase additional common stock. Now, it's important to note, remember our initial investment was $1 million of common stock. We only sold $500,000 of that common stock for $550,000 and then went and reinvested it again. So what we'll do here, modified accrual, current resources, we're going to show cash of $550,000 because that is what we received. Our investment in common stock, the initial investment was $500,000. We want to remove for our books. And then we'll show an investment gain from that common stock of $50,000. We show that transaction to record the sale of common stock. Then we turn around and invest the entire $550,000 into purchase of new common stock. So we'll show that an investment in common stock $550,000 and credit cash of $550,000. It tells us that we transferred expendable income to a newly established special revenues fund during the year. The consumer price index increased by 5%. So the consumer price index of 5% is helping us to see the rate of inflation. So when we are dealing with a $4 million investment and a 5% increase in the consumer price index helps us to understand the inflation rate. So as you can see here, what we're looking at when we're looking here at the expendable income, we received in income interest revenues of $180,000. We also showed our bond investment increase by $3,000. We also showed the gain from the stock of $50,000. So we've actually received $233,000 in investment income, as they've told us it's interest, dividends, and gains. But then what we have to do is look at the rate of inflation. They're telling us that we have to note the inflation rate at 5%, and we need to calculate what that 5% of that $4 million gift is. If we take 5% of $4 million, it's $200,000. That $200,000 is going to need to remain in that permanent fund, and only the difference of income will be able to be transferred into the special revenues fund. So we see here in number 7 that we are transferring what's considered a non-reciprocal transfer. There's no exchange here. It's just transferring over to the special revenues fund so we can record how those monies are being utilized. Non-reciprocal transfer to a special revenues fund of $33,000 and a credit of cash of $33,000. This records our transfer of expendable income. Again, we're dealing with the transactions that are happening in the permanent fund. So next, our job is to close out all of the permanent fund accounts. Remember, we're closing out the temporary accounts. We don't close out permanent accounts. Our temporary accounts relate to the revenues and changes in fund balance. So as you can see here, our interest revenue is going to get closed out. Our investment gains, our contributions. We're going to credit our non-reciprocal transfer over to the special revenue fund, and the difference of fund balance net assets basically closes out the entire temporary accounts there. Those close the accounts. Now, remember that the fund balance is similar to the equity account. So everything gets transferred into that net asset fund balance. That's going to be ultimately the dumping point of the net amount. Now, the next step that the problem calls for is to prepare a statement of revenues, expenses, and changes in fund balance, and a balance sheet for the non-expendable permanent fund. So if we look here, we're going to look at our revenues. Again, it's important to note the title, Kerrville Independent School District Permanent Computer Endowment Fund, Statement of Changes in Revenues, Expenditures, and Changes in Fund Balance. We're showing our contributions of $4 million, our interest of $180,000, and our investment gains give us total revenues of $4,233,000. Again, these accounts are all the temporary accounts, and as you can see, we've closed all of these out up top here. So you know they will all need to be included in our statement of changes in revenues, expenditures, and changes in fund balance. We then show the transfer to the special revenue fund. From there, our increase in fund balance, if we had started with the beginning fund balance, we would have that amount in here and then create a new ending fund balance. As you can see, our balance sheet will show the cash we have sitting. Now you'll notice the cash we have sitting will be the $4 million minus the investments we've made in the bond and the stocks, and then we'll add the interest we received and then the money we received in selling the stock, again minus the investments we did make in purchasing stock. Here we show our investment in our common stock. We started out with $1 million. Remember how we sold 500,000 of it, and then we reinvested 550,000. And then our investment in bonds of $2,973,000, we show that right there. We started with $2,970,000, and we showed then an increase of $3,000 in the bond market value. That will total our fund balance, and our fund balance is a plug-in over here from our statement of changes in revenue, expenditures, and changes in fund balance. How would the permanent fund be reported in the district's government-wide financial statements? Now, this is a permanent fund, so it will be reported in the government-wide financial statement. Those were going to be consolidated with all the other governmental funds, and contributions going to be included in a category of special and extraordinary items, and then the interest and investment gains are going to be included with the other investment income as it relates to the government-wide funds. This is the only problem that we really are going to focus on in these two chapters, but your homework problem is going to be this problem. So those of you that have worked and looked at this lecture alongside with me will have a pretty easy job of completing this problem.